Hi everybody, Patrick Callan here, and today we're going to show you our last video where we give you some bonus insights onto what this actually looks like when you enter into retirement with us and you commute your pension. So the first thing is when your money comes out of your pension plan or you commute your pension, there are two accounts of money that come available. The first one is in the form of what's called a locked-in retirement account, and the other portion is in what we call cash, or just taxable money. Okay, so when you commute your pension, you now have these two amounts of money to deal with and manage yourself. So the first thing to understand is that when you commute your pension, this portion becomes taxable as income in that year. Okay. Now, in the case of $1 million pension, this could be $400,000, which becomes taxable to you in the year you commute your pension. Okay. So with that in mind, if we were to have $1 million pension, the lira would take the other 600. Okay. So how do we effectively do this in that year you commute your pension? The important thing to understand is when you do this, you want to recover as much of that taxes in that year as possible. And there's a couple different ways to do that. So if you were to take a $400,000 income in that year, you would pay roughly 40% in taxes, which would equal roughly $160,000. Okay. So what you would have left is $240,000. Okay, in cash. Now, without diving too far into it, that portion of money becomes something that we plan for and we know what we're going to do with it if it's better suited somewhere else. But anyway, the main strategy is we want to recover as much of that $160,000 in taxes as possible, and there's a couple different ways to do that. One of them is in the form of an RRSP for you as the person who commuted your pension. And the other form is what's called a spousal RRSP. Okay, so if your spouse has RRSP room, you can use that as a way to recover some of this money. So under the assumption that you have some room in these accounts, or types of accounts, we can funnel some of this money here to recover this tax. Okay. Now, another strategy that we try to use is the timing. Okay. So ideally, we would want to get you to commute, if possible, in January, because this means that you haven't had a whole year of earnings to add to this money. Okay, so that's another strategy to look at. Okay, so under this assumption, if we were to funnel, say, $200,000 into an RRSP or a spousal RRSP, okay, we would recover the amount of taxes that you would pay on that money. Okay, and in this case, that would be roughly $80,000 returned to you that year or the following year in your tax return. Okay, plus the $40K we still have left over, plus the $600,000 locked-in retirement account. Okay, and this would net out to be $920,000 in your portfolio. So the overall taxes paid would be roughly $80,000. Okay, but I want you to remember that number and don't stress about it. Okay, so this is what we would have to work with now in the form of your portfolio. Now, the reason I don't want you to worry about this number is because now that we have this portfolio, we can manage it in a tax efficient way for your withdrawals. Okay, we have a $600,000 lira. Okay, $200,000 RSP. Okay, and then 120K in cash. Okay. Now, when you compare that to your pension income, it is 100% taxable. Okay. Your annual salary or your monthly income from your pension is 100% taxable. Whereas here, we can invest in the appropriate way to reduce that amount of tax on an annual basis. And it usually takes about 8 years to make this up. Okay, so we recover that in the form of a more tax efficient income coming to you over time. Okay, so with that being said, now this money has to now be managed appropriately. We have a $600,000 lira, a $200,000 RSP, and $120,000 in cash. Okay. Of this $920,000, 600 or the most of it is in a lira. Okay. And this is where the real expertise comes into play, because liras need to actually be converted to what's called a locked-in income fund, or a LIF. And these accounts have minimums and maximums every year for withdrawals. And the older you get, the larger they get. Okay? You don't actually have to start taking money from these until the age of 71, just like an RRSP. However, when we plan for your pension income or your retirement income, we do a benefit analysis to show where the money should come from, which portion, and when. Okay? So with that being said, this is a big portion of your pension. It has to be invested appropriately, and the income has to be withdrawn appropriately. Now, you have your RRSP. Okay. Okay. Same thing, you do not have to start taking from this until you are 71. Okay. And then you have your $120,000 in cash, which we can split into tax-free savings accounts for you and your spouse, or just you, and then invest accordingly as cash. Okay. So now you're starting to see how your portfolio is actually being constructed a little bit. Okay. And the last part is, after your accounts are structured appropriately, is the actual investment. Because as we said before, if we can match your withdrawal rate with the appropriate return, your money will never run out. But the important part of it is this: has to be invested appropriately. Okay, and that is the actual final step. So as you can see, there is a lot of expertise and a lot of planning and some calculation that goes into setting this up the right way for you. But at the end of the day, it is actually the most important part. And this is truly where your wealth is secured, created, and will last forever. Okay? So I hope that gave a little bit more insight into the final steps of getting you into retirement and exercising option 8. And thanks for sticking with me.